What is up, you guys? Pete DiCarlo here, and today we're going to talk about leveraging debt, the do's and don'ts, and how to make the most return on your money. What is up, you guys? Pete DiCarlo here, and if this is your first time, make sure you hit that like button and subscribe down below. We talk about stock market investing, real estate investing, how to start and grow your own business, and go over your personal finances. In this video, I want to go over exactly what leveraging debt is, why you shouldn't leverage debt in most cases, but I also want to go over in what situations leveraging debt is a good idea. If you haven't already, hit that like button and subscribe. It really helps the YouTube algorithm and helps this channel grow. So the first thing to really go over is to explain what leveraging debt is. Now, we all know what debt is. There's good debt and there's bad debt, but there are ways for you to control higher amounts of money or assets than what you currently have. So in short, leveraging debt is just using your own principal and acquiring debt to control an asset of a higher value. Say you only have $20,000, but you want to buy a $100,000 piece of property. You can use that $20,000 and leverage 80% of that asset's value through debt. And so it might seem like a no-brainer. Why would I not just bring on debt to control assets that are worth more money, to build my portfolio and give myself better returns? But the truth is, if you don't know what you're doing, bringing on unnecessary debt is something that could cripple you as an investor. And now I want to go over some things that you should never leverage debt for. One piece of advice that I would give you is to never leverage debt in the stock market. Now, in the stock market, leveraging debt is called margin. And what a lot of people will do is they will only have $10, $20, $30, $40,000, but they want to control a portfolio that is worth $50, $60, $70, $80, $100,000. And what some brokerages will do is they will lend you equal amounts to your portfolio. So say you have $25,000 and you want to control $50,000. Well, a company like Robinhood will spot you the $25,000, but they will charge you an interest rate every year. And on top of that, obviously you have to pay them back. Now, there are other brokerages such as E-Trade who will actually sometimes do a 3 or 4 to 1. So if you control $25,000 in your portfolio, but you want to move $100,000 worth of assets in the stock market, they will spot you that money and allow you to do that. Let's say that you have a Robinhood account, and in this Robinhood account, you have $35,000, which puts you in the highest bracket of Robinhood Gold. Robinhood will therefore say, because you have $25,000 or more in the market, we will give you a margin of $25,000. So now you have $35,000 principal and $25,000 in margin. So say all of your money is in the market and you have a long-term portfolio and the market starts to tank and we have a correction. Now you're down 10%, 15%, 20%, and you decide this is a good time to buy more stocks. Because in theory, it is. As the market is starting to pull down, you should, in a long-term situation, continue to just put money into the companies that you fundamentally believe in. But now let's say that your $35,000 stock portfolio is worth $28,000, and you decide that you're gonna throw the other $25,000 into the market. And instead of recovering, the market keeps going down and going down. Maybe a recession happens. Now you're down 30, 40, 50%. And what will happen is called a margin call. Once your account is under a certain amount of money, say $25,000, Robinhood will make you sell some of your assets to cover their behind so that they can get their money back. And guess what? If you don't do that, they will do it for you, which means they might sell positions that you don't want to get rid of. They might sell all of your positions. I've never had a margin call happen to me, fortunately, but it's something that could ruin you as an investor. Because say your brokerage like Robinhood sells all of your position and the market takes a turn back up, you will not get any of that. Robinhood might sell all of your assets at the lowest price. I have seen margin calls happen to not only day traders and swing traders, but long-term investors alike. If you're afraid of a recession or a market crashing and you're like, all right, I would like to have margin on the side so that I can buy more stocks, instead, what you should do is say you have $25,000, take 60 or 70% of that money, put it in the market now, and save 40 to 30% in cash. Not actual cash in your house, but in a portfolio that is considered cash and something liquid. This way, if the market pulls back 10, 20, 30%, you can use that cash in your portfolio to average down. Now, the next thing to talk about is leveraging debt in a business. And now overall, I don't think that anybody should leverage debt in a business unless you have a lot of experience being an entrepreneur, you understand your financials, and you understand your market so much that leveraging debt is important and it will bring you to the next level. Now, I will give you an example of a good way to leverage debt in a company. Let's say that you own an LLC with a couple of friends and you guys want to start to get into real estate investing. Let's say you buy a rental property that's pretty dingy on the inside. You're going to have to put a couple $1,000s into this property to get it rented. A smart way for you to leverage debt would be to get a business credit card. Now, a lot of business credit cards and credit cards in general will have good signing bonuses. I've seen some that are like spend $5,000 in your first 3 months, get $1,000 cash back. This doesn't mean that if you get this card that you just go and blow $5,000 on something stupid just to get the $1,000 cash back, because that doesn't make any sense. But if you know when buying this property, you're gonna need all new appliances, you're gonna need to paint, put flooring in, what you can do is estimate how much it'll be, and if that is the amount that that signing bonus is for, take the credit card out, get the work done because you were gonna do it anyway, and get that signing bonus for free. That is a smart way to leverage a little bit of debt and get a nice signing bonus from a credit card company. But what you don't want to do is write down your estimates, find how much it's going to be to redo an apartment, and it's only $2,000, but the signing bonus you have to spend $5,000, and therefore you just rack up unnecessary bills and you don't have the money to pay it back. Now, I want to talk about when you should leverage debt. And in my opinion, besides that little example about the business credit card, this is the only time you should actually leverage debt. The only time you should leverage debt is when you're buying real estate. And now, don't go out and buy 5, 6, 7, 8 properties in a couple years, leverage all your debt, spread yourself too thin, because that is not good either. Because what will happen is if you only own like 5 or 10% of a property and you leverage the rest of that debt, your mortgage insurance is going to be insane. Your interest rates are probably going to be high because you're more of a liability. And if something bad happens to the economy, your income, or say you need a new roof or something bad happens, you are going to be screwed and you're going to end up defaulting on all of these loans and end up losing the assets that you do control. Good example of how to leverage debt is what me and my friends did with our first rental property. The property that we first looked at was a duplex in Prospect Park, Pennsylvania. We closed on the property for $150,000, which the reason we got it at that price was because it was as is. And honestly, I would never do that again, but that's for another video. But in my eyes, at the time, even distressed how it was, the property itself was worth about $175,000 to $190,000. So instantly, we were getting some equity in the deal just by buying it at a cheaper price. Now, yeah, we did put $5,000 to $10,000 into this place over the past year just by getting a new heater and redoing some of the unit. And as a side note, while I'm a proponent of buying a wedge deal, which means say a property is worth $200,000 and you're buying it for $150,000, while you are instantly making $50,000 in equity, don't ever look at that. If you are buying a property that you want to rent out for the rest of your life, don't care so much about how the property is going to appreciate or how much equity you're buying in the deal. Think about cash flow, because cash flow is king. Because at the end of the day, if a property cash flows, you have no reason to ever be worried. Now, like I said, we settled on this property for $150,000. And I knew from the beginning there were 2 units and each unit could easily rent for $950 a month. And when we finally settled, the total cost to acquire this property was $37,964. $30,000 was 20% down on a $150,000 property, and the rest of the money was closing costs, realtor fees, and other things. So now by spending $38,000, we control a $150,000 property, and we're also making $822 a month in cash flow. So already you can see the power of leveraging. Even if you take the actual price of the property, we are still spending $37,000 to make $822 a month for the rest of our lives. Now we'll talk about appreciation. We bought it for $150,000, and now with just appreciation and fixing up the property, this place is worth $220,000. So now you can see that just with $38,000 and knowing how to leverage debt in real estate, we were able to make almost $20,000 in 2 years off of just cash flow alone, and another $70,000 in appreciation. So as you can see, if we were to sell right now in 2 years, we would make close to $90,000 plus our principal back. That's almost doubling your money in 2 years. Now, while that's awesome, we did time things correctly. We did our due diligence. We bought a good property in a good area. We knew what the rents would be for, and we knew that we were buying it undervalued. But remember, appreciation is just icing on the cake. We could have bought this place for 150 grand. The market could have tanked. It could have been worth 80, 90, $100,000. But at the end of the day, it's still, worst comes to worst, would still cash flow, because in a recession, people are going to rent. And when you're looking to buy a good rental property, cash flow should be the only thing that you look at. My goal for 2020 is to put 2 to 3 high quality videos out every single week for you guys. I'm gonna be extremely active this year. I wanna grow this channel this year, but I'm not gonna say every week I'm going to for sure put 3 videos out, because you guys deserve the highest quality that I can put out there. And I don't wanna put something out that I'm not proud of. So I wanna thank you guys for watching. Share this video if you got anything from it, and I'll see you next time.